to Electric Royalties Live Investment Summit, whose ticker is ELEC on the TSXV and ELECF on the OTC markets. Today we're hosted by Six, of course, and I'm pleased to introduce the CEO and Director of Electric Royalties, Brendan Yurik. Brendan's going to walk us through a company presentation, and after, we'll be taking questions live. Remember that you can submit your questions using the Q&A panel found on the right-hand side of the screen at any point during today's presentation. And as always, this event is being recorded and will be available to watch on Six.com in the coming days. Without further ado, Brendan, I want to hand things over to you and get us started.
Thanks. I appreciate it. Hello. I am the CEO and one of the founders of Electric Royalties. We are a royalty company set to take advantage and benefit from the transition to clean energy. We are targeting those 9 metals really required for the clean energy transition as the world transitions to a decarbonized global economy. Electric vehicles definitely part of it, but we're also talking about grid storage, renewable energy, and essentially, this is going to have a big impact on a number of metals that, to date have not been, essential for the life that we live. But over the next 10 years, we're going to need to produce more than we have really in all of human history. And so, this is a sector that as of 5 years ago, barely existed, and 20 years out is looking to essentially replace what the oil and gas industry is today. So we have exponential growth forecasts really across the board over the next couple of decades. And it's an exciting time. We're the only group out there right now focused exclusively on these clean energy metals and really using our first mover advantage at this point. We've got a great management team. We've got a producing royalties, so we are generating cash flow. And we've got a number of portfolio royalties that are moving towards cash flow as well. So we've got 20 royalties right now in our portfolio. We are diversified across all these clean energy metals, so we have exposure to all of them. We're a little bit heavy lithium right now, but lithium prices up about 500% this last year, so it wasn't necessarily a bad bet. We are really targeting those deposits within North America, Europe, and Australia that could be a domestic source of supply of these metals for all of the gigafactories coming up under construction in those jurisdictions. And I think that's really becoming more timely as we move forward. Right now, where we're at today, we are well cashed up, better cash than we've ever been in the company's history. Right now, we have $4 million cash. We just announced a deal to sell a part of one of our royalties, Seymour Lake Lithium royalty, that we picked up last year. So on a pro forma basis, we're selling that for $4 million. Pro forma, we should have about $8 million cash in the bank, which is a lot of money for us to be able to go out and do deals. We have no debt. On any given day, I think our market capitalization as of today is around, 20 million. I think we're grossly undervalued. I'll kind of run through that as we go through the deck. But we're a pretty tight shareholder structure. Myself and my family own about 12-15% of the company at this point. We have a number of key shareholders that really kind of get us up to about 50%. And then a number of high net worth individuals that own large stocks as well. So most of the stock is in friendly hands, and relatively tight today. Moving on. So if you look at that valuation, 20 million on a pro forma basis, we're supposed to have 8 million cash. That's really an implied enterprise value of about 12 million bucks, for the rest of our portfolio. And this is our portfolio. The Middle Tennessee Zinc royalty, this is a producing royalty. We picked it up last year. We brought Sprott in as a co-investor. They put up 13.5 million cash to partner up with us on that. That's paying us about $500,000 this year, on track to. And we have an option to increase our exposure, really double our exposure to that asset. It's operated by Trafigura. They've only ever had about 6 years mine life ahead of them, but they've had a very good track record of continually adding reserves. The mine's produced already about 2.1 billion pounds of zinc to date. And so we're expecting that'll be producing for a while to come. GRAPHITE, this is a past producing mine. They were operating for about 20 months continuously, shut down because of COVID restrictions in the country of Madagascar. But they're doing a resource update right now, planning to bring that back into production. OCE, the next royalty on this list, the operator just raised 150 million to basically help put this asset into production. They've acquired the mine, an operating mine, the only former producing lithium mine in Canada. OCE sits right next door to that. And with that capital, they're going to be able to put that, move that ahead into production. And they're targeting 2023. Biscuit Creek, The operator of this is now becoming the third largest graphite producer outside of China, and they said they want to make this their flagship. And so this is a fantastic asset. It's construction ready. It's 15 hours transport from the largest gigafactory coming up under construction in the U.S. But all three of those assets, we're expecting to make some big achievements here over the next kind of 12 to 24 months. Beyond that, we've got a fantastic development portfolio. And remember, this is all kind of included in that 12 million enterprise value. I'll just start with Battery Hill. They finally filed a PEA on this just recently. We had a news release on it this week. 47-year mine life. Forecasting, I believe it's over 120 million US a year in revenues. You can do the math. We have a 2% gross revenue royalty on that. I think equated to about US $3.5 million a year once in production. And that's pretty much base case. Mines always add years to their life of mine. And I think pricing, if you look across the board, has been very strong, and we continue to see that as we move forward. But we've got a number of royalties. There's lots of stuff going on across our portfolio. We've had about 23 updates across 11 assets this year. Our most recent acquisition, Zonia, which is number 5 on this list. It's a fantastic copper asset. We are going in, generating a new royalty. They have a PEA. Our funding is going to get them through feasibility study within the next 2 years. And I'll touch on that a little bit more as we go through. Mont Saucier, this is our vanadium exposure, probably the best iron ore development project in North America. They're working towards feasibility study right now with Glencore. They had a 40-year mine life. We're excited to kind of see that results. Seymour Lake, that would be the royalty that we are currently selling a piece of right now. That operator has raised about 70 million in the last 8 months alone. They're rapidly moving these assets along. And I'll touch on our lithium portfolio, the specialness of it later. Millennium, high-grade copper project in Australia, has a JV partner. They're drilling it actively right now. We're expecting assays to come out within the next few months. We're excited to see that. At Canset, this group actually also raised about $18 million in November last year, and we're expecting to see some exciting announcements. I'll touch on that on the next slide as well. But again, hard rock, lithium asset, Eastern Canada, moving very quickly along the development timeline. And then our Rana Nickel project, that's a past producing nickel mine in Norway. We closed that out just at the end of last year. And they've got a JV partner right now in the process of going public. And they've committed to doing a work program this year with an updated resource expected in the year ahead. So really across the board. And there's some bigger news across the rest of these assets, but I'll move on from there. We've had about $400 million raised and going into our assets really over the last 18 months. So that's a lot of money, didn't cost us anything, and creating a lot of value for us in the ground. In terms of key upcoming catalysts, I just went through and we've already had about 20 just this past year alone. So, there will be more that come out. It's just about our ability to really kind of set a timeline on them and predict. But we're expecting a Seymour Lake lithium resource update. That should be coming any day now. Graphmata is putting out a updated mineral resource in the near term. That's really ahead of them restarting that mine. The reason for is they want to do that at double the production capacity they had previously. So they decided, okay, we've got to up the resource, make sure we can sustain longer life of mine, but we're expecting that in the near term. Our Othe lithium royalty, they've actually just done a PFS. There should be an updated FS coming out soon. Like I said, they've already raised the money. So they're capitalized to put that into production. Expect some more news as we get closer to the end of this year. Millennium Copper, I mentioned, we've got some drill results coming out. Looking forward to those assays. You could add Chubb Lithium in here as well. That's another asset they just upgraded. The drill program is right in and around the Canada lithium mine. But lots of different catalysts come in, and that's really one of the great things of being a royalty company. But I'll touch on that as we move forward. So the world's really going to need a lot more metal. If you think about it, a lot of these markets, were 100,000 tons a year up until recently, and we're forecast to need 5, 6, 7 times that over the next kind of 20 years. So mining is a special industry. It has an average development timeline of 15 years, which means that you can't speed up or make up for a period of underinvestment. And there has been a huge lack of investment in this space going back a long time. I joke around, look, you tell me you need more tin today, great. I will go poke a drill hole down. we're so lucky. I found some tin. I might be able to get you some tin 15 years from now, right? So it's really hard to overcome that lack of supply. And that's really the big issue. I think that's the one side that people really misunderstand because it's the toughest to wrap your head around. But the supply side for all these metals is very weak. And on top of that, you have this real exponential demand forecast as we move forward. So metal prices, look, this is as of pretty recently. So you've already experienced the drop that's happened. They were much better, as of say 3 months ago, but still very strong, and like I said, our portfolio is heavy lithium. Lithium prices, even with the come down, is already up over close to 400% this past year alone. And, it just doesn't make sense because our share price is, down here, and our revenues, our expected revenues, which really is our valuation, is directly proportional to metal prices, right? There's only 3 numbers in the calculation for our expected annual revenue. It's our percentage royalty, times their production rate, times metal price. So our revenues are expected directly proportional to metal price increases. And like I said, with a heavy lithium portfolio, last year was very good to us. But as you can see, we really haven't caught that bump, which means we're a good way to get exposure to this space. So we have a fantastic space, right? I think it's very rare that you can see 2 decades of opportunity ahead. And we feel that way about this space. The other key piece of the business is being a royalty company. There are a lot of benefits. I think it's the best business model, that we have in mining. But we have no holding costs, right? It costs us nothing to hold these. We do not have to invest more capital and dilute ourselves moving forward on these assets. Like I said, last year, over the last 18 months, we've had 400 million raised. All that money is going to our assets. That would have been, a lot of dilution for us if we had to go do that ourselves, multiple of about 10. So, we don't have to put any more money in. We're not on the hook for capital costs, building costs, cost overruns, etc. Our operating costs are 0 on a unit basis. So we're hedged against capital cost inflation. We're hedged against operating cost inflation, which is fantastic for, a market like this. We have all the same benefits of investing in a mining company. We have leverage to commodity prices. We do get exploration upside is a big perk of royalty companies. If they decide to, produce more, we also get that benefit. So, a lot of the same benefits, but a lot of advantages as well. We have very low G&A. Our G&A is extremely low. We're going to be cash flow positive as soon as, our second and third royalties come into production. And so you don't really need to build out a big team, which is, again, really advantageous. All of our money really goes towards new deals. The other kind of key piece, just kind of an added cherry on top, because we're dealing in good jurisdictions. There's good established mining codes, regulations. We're actually able to register our royalty against the project. And that really protects us against, if management takes on debt at the wrong time, loses the asset for whatever reason, as it happens, whoever takes that asset on forward, moving afterwards, I'm still going to have to honor and pay our royalty. So, that's a nice little bit of extra security. Just kind of reduces our risk profile as we move forward. So yeah, royalties are pretty simple. We kind of give upfront capital, an upfront payment, and they basically agree to give us a percentage of their revenue from the mine once they're producing. We tend to target gross revenue royalties, so there's no deductions. It's straight off the top, very easy to calculate. We are one of the few junior royalty groups out there. We create new royalties. That means our royalties typically cover the entire project. We do them as gross royalties, and we're the ones drafting them, and we do that for a living. So the contracts are generally a lot better. But a fairly simple business model, works very well in a market like this where equity prices start to get depressed. Royalty financing, all of a sudden a much better option in terms of dilution. So we've got a fantastic lithium portfolio. Most of our assets are hard rock lithium, Eastern Canada, and that's a proven technology. I think those are the ones that are going to come in online first. There's a lot of lithium in the world, but we've still not commercially extracted lithium from clays. That's where most of the Nevada future production would come from. So we've made a pretty safe bet. It's mostly in and around Quebec, Ontario, and there's a lot of money going into our portfolio this year. It's perfectly situated, along with a lot of our assets, to really service these gigafactories coming up under construction in the US, as you can see here. So this is our lithium portfolio. OJ is definitely the most advanced of our lithium portfolio. We're expecting that's going to be, we'll be able to give you a more determined guidance within the next kind of 6 months. But we're expecting that there could be production from that in 2023. The company has acquired the mine sitting right next to that. They've already done a updated they've done a DFS. They're updating the FS right now. Seymour Lake, we picked that up last year for about $1 million in shares. We just announced the deal to sell 2/3 of that for $4 million cash. We're going to keep some exposure, but we felt like we should monetize that, given where our enterprise value was, as I discussed. CanSet, another exciting asset. We picked up that last year as well, ahead of lithium prices really taking off. Our cost of acquisition, definitely industry leading, I would say. We paid, again, $1 million in shares on that. We're expecting a resource coming out, and they could put economics on that pretty quickly. Chubb and Bouvier are both in and around the Canada lithium mine. It is the only producing lithium mine that has been in Canada. As much as everybody talks about lithium and all these metals, the actual production and the number of mines that we have domestically is really shocking. Sona East, Sona West, really in and around OJ. So if they have some success there, we'll definitely be benefiting from that. OJ, yeah. So we have a 0.5 gross revenue royalty. Unfortunately, this is probably one of our only royalties that doesn't really cover the whole project. Covers about 50% of the asset, but really the meaty part of the deposit, where we'd expect to see a lot of exploration. Look, they've raised a lot of money this last year. They just closed out another $150 million financing. So these guys are fully funded to take this forward. And we're looking forward to that. It'll be our first lithium cash flow. Just between this and our Mid-Tennessee zinc mine, we're pretty close to cash flow positive. So on top of that, these would be the other two assets in our portfolio. From a lithium perspective, we look at as our kind of development stage. CanSet, they're actively moving this forward right now. Like I said, raised $18 million last year. This is a nice deposit. Most of the drill holes have been very shallow. And the crazy thing about these things, there's quite a few of them out there that are in Eastern Canada. Not that many, but it doesn't take a lot of money to develop these assets. You're used to looking at balance sheets in the mining space, and equity is minus 40 million, minus 50. With $15 million, these groups can, in our minds, get through a resource and get through a PEA, showcase those economics, and at these prices, the economics all look very good. So we're looking forward to updates coming on that this year. Graphite, we've got a very good graphite portfolio. We've got 3 different assets. Graphite is definitely the most advanced. It was already a past producing mine and really just shut down because of COVID restrictions. The company's been using that time to upgrade the resource and do an expansion case restart. And so they've come out, they've stated they want to restart that mine in the next 6-9 months. Our expectations, that'll pay about US $1 million a year once back in production. And between OJ and Mid-Tennessee, that does make us cash flow positive. Bissett Creek, as I said, this operator is now a producing company. They stated they want to make this their flagship. And so we're going to be looking for project financing and offtake discussions this year. And Yabra, which I didn't mention before, it's an earlier stage high-grade graphite project in Australia. And it actually, they will have some metallurgy results coming out here in the near term. Yeah, so GRAPHITE mine. I mean, look, Madagascar, we said we'd be primarily targeting North America, Europe, Australia. There are some cases where maybe we make a special exception. Madagascar seems to be a special place for graphite. And, we love this project. We picked this up as part of our partnership with Vox Royalties. And, they're going to be doing a number of work items this year. So looking forward to that and project financing, hopefully over the next kind of 3-6 months. Bissett Creek, fantastic project. Like I said, it's right in and around all these battery plants coming into construction. They've got about 70 years of resources. So, mine life of 21 years, but, an actual life that we expect going to be much, much longer. We have an option to increase our royalty on that. We're expecting that's going to be about US $1 million a year once in production. It's got about an 18-month construction time, and really just kind of looking for that project financing. Hopefully that comes in the next kind of 6 months, 12 months. Zinc portfolio. This is our producing royalty, and it's been paying for a while now. Quite a long time. As I said, it's produced this month's produced 2.1 billion pounds of zinc to date. We're expecting to be producing for a long time to come. It's really a mining complex made up of several mines. Trafigura took it over from Nearstar at beginning of COVID, really. And so they've been deploying some capital. We're looking forward to seeing some updates from them. But this is vertically integrated with the Clarksville smelter, and that's the only primary zinc producer in the U.S. That's crazy, to me. But it's really kind of a critical piece. It's got a very clean concentrate at the mine, so there's some strategic imperative, to keep that operating. Despite that, now it is making money, but it is nice to have that. Essentially, the only primary zinc producer in the U.S. I mean, the zinc market is a big market. It's about 12 million tons globally. Very few people understand it, but I'd say the supply side is much weaker than it is in most of these metals. But very big market, one zinc producer in the U.S. We love zinc. It's going to be, in our eyes, it's a very big part of renewable energy, but we also see it playing a big role in energy storage. Our role is really to, we want to stay diversified across all of these metals. In that way, we're not trying to make a bet where battery chemistries go, what new technologies come and disrupt one metal or another. But we do feel like the whole world's always going to try and use cheaper metals if they can. Zinc is a perfect candidate for that. It also happens to be easily recyclable. So we expect zinc to be a big player in the clean energy revolution moving forward. Manganese portfolio, again, going with this kind of concept of how few deposits we have domestically. Battery Hill is really one of, the only district in North America being developed for the EV space. There's only about 5 of these developers out there globally, and they just put out a fantastic PEA. Showcase the numbers here. 177 million US a year is expected revenues. Our royalty is 2% gross revenue, so that's right off the top. You can calculate that, and they have an initial 47-year mine life, but these are very, deposits are very easy to add. Extra resources fairly cheap. We'd expect that definitely to extend. But this royalty alone, you can do the cash flow numbers. I believe this royalty alone is a case that on its own would be more than our valuation. So, we're definitely cheap today, but looking forward to, them moving that forward. I'd say the metallurgy is more advanced on that than people think. So PEA might make it sound like it's a bit early, but they've been working on the metallurgy for about 3.5 years with Cameco. And that's obviously a key piece of dealing with these metals. Vanadium, I'll say this, of all the metals that we chase, vanadium is probably the one that we're most wait and see about. The reason being for that, 70% of vanadium production still comes from sludge from the steel industry. All of the primary vanadium deposits in the US, don't really make economic sense at current prices. And demand's really kind of forecast off of the expected technologies in the energy storage space, which haven't been commercialized yet. So, we're waiting to see, but we're interested in vanadium. We like vanadium. We've got some exposure. We did it through a byproduct on what we believe is one of the top iron ore development projects in North America, partially because of that byproduct. But they brought in Glencore last year. Glencore doesn't usually come in that early. So I think that's a real sign of strong support for the project. They doubled the resource last year, and they keep moving that forward. So I believe they have targeted end of this year, start of next year for a feasibility study. But we're very much looking forward to that. Our royalty is just on the vanadium. We forecast that'll be about US $1.5 million royalty revenue on an annual basis once in production. Copper portfolio. So we were a bit weak on copper. Look, I love copper. I think the thing about copper is we've been looking for a long time. We've been exploring the world. We've been making less discoveries, way less discoveries. And we're mining all the best deposits we have on Earth right now and have been. And so, it's unlike some of these other metals where we really haven't even been looking for the past 10 years. Copper we have been, and we haven't found any more. So, the copper supply side is going to be interesting. You need copper for so many things in everyday life now. So we're definitely going to keep boosting our exposure to copper. But we were excited. We picked up just recently announced our Zonia royalty acquisition. We're going in, funding them through a feasibility study. And, these numbers are all done at a copper price that's much lower than today. So we're expecting those going to be looking even better. Our deal right now is we have an option or a deal to acquire a 0.5% gross revenue royalty for 1.5 million cash and 2 million shares. But we also have an option to increase our royalty. That goes out 15 months. So, if things are going well and as we expect, we have option to increase our exposure as well. But we love this asset. It's a copper oxide development project. Most of those have been mined out. They're right at surface. They're fairly simple technically. At these prices, it's going to make a lot of money. So it's in Arizona, great jurisdiction. I'm really excited to see that moving forward here over the next little bit. They've got already over 500 million pounds of copper in the ground. And I think they'll probably bring in a few more pounds when they update the resource. And the Millennium, high-grade copper project in Australia. The metallurgy is very, very good on this. They have cobalt and gold credits, but they all recover quite well. So if they have some success in the exploration, that could be very interesting. And we're looking for those assays to come out later this year. Cobalt portfolio. A lot of people think cobalt is going to be removed, but I do think it'll always have a role, especially with all the high energy applications. The real kind of high end stuff. You'll need some cobalt. But cobalt prices were up over 60% this last year. We're a little bit light on cobalt. We will look to add some exposure. But like a lot of these metals, right? You have 60% of tin, cobalt, graphite, all produced out of China. Yet 99% of manganese sulfate produced out of China as last year. So there is definitely a need for domestic sources and supplies of these metals moving forward. And I think if you look around globally, the world's starting to pay a little bit more attention. Our nickel portfolio, we just closed this out, our first nickel deal at the end of last year. We're expecting they're going to have a new operator coming and taking that forward. Right now, they're trying to go public on the AIM exchange called Metals One, and they've committed to a work program. So, look, we like this. I mean, the mine shut down back in 2003. Nickel prices were about $3 a pound. I think they hit just 15, not too long ago, about a month ago. And so at these prices, it's a different beast. It hasn't had any modern exploration really since then. Lots of exploration upside. And when they left, they actually had remnant resources equating to essentially their entire production history of 10 years. And so, if they go in, they have some exploration success. They've got a lot of the infrastructure there. It's 2 kilometers from the port. They actually have a conveyor belt. Direct actually goes right from the mine to the port. So that's how close it is. So exploration success, this could be a much different story to talk about at the end of this year. Tin. Yeah, tin is a crazy one for people who are familiar with our company. They know how much I love tin. You could put every development project we have out there, into production over the next 5 years. I still don't think we get to where we need to be on tin demand. And that'll never happen. You'll never put every development project out there, but there's very few of them. Tin occurs in a few places around the world, around UK and Europe and in Tasmania and Australia. But there's not that many tin deposits. The US has not produced tin since 1980. We just picked up our first tin royalty. It's one of 2 potential economic deposits of tin in the US, and that's the USGS's words, not mine. But that's how crazy it is. And this is, a little bit early. It's pretty early stage. It's the only project out there for tin that has any kind of semblance of a resource. We're excited. So we believe this will be the first tin mine to come in production in the US moving forward. But there's not a whole lot of options out there. We're looking forward to a partner coming in, really realizing and taking this forward. But it's just kind of crazy. No tin production since 1980. Tin's a very important metal. They call it the glue that holds all of these electric metals together, mostly used for soldering. But the first international trade networks ever, going back 2,000 years ago, came together because of needing tin. And I think we're going to see some kind of withdrawal to that as we move forward. So like I said, we've got a great team. Myself, I'm the CEO Director, one of the founders. My whole career has basically been spent in alternative financing, mining finance advisory. I started my career with Endeavour Financial in London, and have moved back to Vancouver and worked with most of the mining groups here in Vancouver. So this is kind of what I did. Usually I'd be advising the clients, the companies. Now I'm just coming saying, hey, we don't need anybody else. So it's easy to try and get deals done. Our chairman, Marchand, he's also one of the founders, and he's also a co-founder of RE Royalties. These guys 3 years ago were the first movers to create a renewable energy royalty company. I think they've got around 100 royalties now over the last 3 years. And so they're kind of like a sister company. We share chairman and our CFO, Luke Minicon, as well. But we were the first group to do this, so fantastic experience. Bob Schaefer, he was one of the directors of International Royalty Corp, sold on to Royal Gold for about $800 million. So that's, that was a very big success story here in Vancouver. At least we know a lot about it. But great royalty company experience, great guy to have on our board. Former chairman of PDAC. Everybody I talked to, they usually know Bob ahead of me, so helpful in that direction. Craig Lindsay as well. We picked him up as part of our RTO. I've known Craig a long time. He's an awesome guy. He's also been a very successful entrepreneur in this space, founding multiple different companies and leading them on to successful sales. And then David Gauntz, our chief geoscientist, really works very closely with me to model these resources out, do our technical due diligence, as we move forward. And then, we're navigating a very tricky space. So we felt like it was important to go get some extra advisors out there. Greg Bose, he is the CEO of Northern Graphite. They're going to become the third largest graphite producer outside of China. And he's got a wealth of experience in the graphite space over, the last 15 years that he kind of helps us navigate. Rod Cooper, former SVP Technical Services at Kinross, fantastic engineering, around operating mines. Marcel Schlumberger and Nick Schlumberger, they are from that wealthy oil family, but they have fantastic family office connections. Marcel's a good friend. They also keep us up to date in terms of, what technologies are coming on the clean tech side. Richard Williams, he would be our advisor as far as tin goes. He's the CEO of Cornish Metals. We did pick up our first tin deal off of them recently, but they've got a very exciting development project in the UK. And then Darcy Marood, he's the former senior VP exploration at Yamana, led their entire global exploration portfolio. And really, exploration is probably the biggest upside of royalties that's least talked about, but kind of a given. But he gives some fantastic insight, towards that front as well. So look, everything's been going our way except our share price, which is the crazy thing. We've added about 7 royalties over the past 12 months. We've got a producing royalty. We have several more that are looking to enter production over the next 12 to 24 months. And we have a huge development portfolio of assets where they're best in class of these commodities within these jurisdictions in North America, Europe, Australia. Battle demand growth is expected to exponentially grow, despite any short-term lulls. And the supply side is very weak. So we're expecting prices higher across the board. Royalty company, we've got enough cash. We're going to have enough cash on a pro forma basis. We could batten down the hatches forever. G&A is very low, and we have no ongoing costs, no holding costs, and no capital costs to put these into production. That's all done by third parties at no cost to us. We're protected against capital cost inflation, operating cost inflation, and metal prices are going up. So I know that's a little bit over the last couple of months, might seem counterintuitive, but over the long term, the supply side is too weak that you will not be able to keep up. And we've got the great team to do it. So, I think definitely for new shareholders, this is the time to get in. We are trading in and around, where we went public at 2 years ago, despite hitting all these milestones, growing the portfolio, and having a number of catalysts coming forward. So, with that, I will pass it over and see if anybody has any questions to ask.
Great. Thanks so much, Brendan, for the great presentation. I'd like to remind everyone in the audience that if you do have any questions, please feel free to ask them in the Q&A tab found on the right-hand side of your screen. Brendan, we already got some questions that come in. First one, would you continue to monetize your portfolio if capital markets don't recognize the value that you've created?
Oh, yeah, 100%. Yeah. Look, at the end of the day, that deal that we did was about, setting a valuation on that asset, monetizing a piece of it. We were a bit heavy lithium. We picked it up for $1 million in shares last year, and we flipped a part of it. So we still keep exposure, flipped a part of it for $4 million. So yeah, that was closer in line. It's still cheap, to where we think we should be, but it's so much better than our current valuation, which was ridiculous. So yeah, if equity markets do not improve, diluting at these prices is not even really an option on an equity raise. So yeah, we would look to basically use that difference between private equity valuations and where we're trading at in the market to capture that gap and monetize it.
All right, great. Does an economic backdrop of high inflation and rising interest rates give cause for concern about the speed of development towards production for mining companies, do you think?
Yeah, well, I mean, it's, capital cost inflation is a real thing. Operating cost inflation is a real thing. And I expect both of those to be pressures. I think ultimately, despite this kind of recent pullback, metal prices are going to go much, much higher, really across the board. And you've seen it with lithium first. Lithium was one of the most well-known. It's got a lot of the spotlight. But I expect you'll see that across the board for these metals. And so, I think this should be a fine environment. I also expect that the end users are going to come and play a little bit, kind of further upstream with us because they're going to have to. There's just not enough capital going into this sector. And ultimately, those guys have already put hundreds of billions of dollars into building plants that need these metals. So they really kind of put the cart before the horse. And so I expect that those guys will be some of the biggest money that comes to the table over the next few years.
Right. Okay. Is silver a possible diversification? Or is uranium a step too far from your concept?
I guess in theory, uranium is a clean energy metal. There's one group out there that's all uranium. We just felt a little bit different about it. Not necessarily against it or anything, but just with its use in nuclear. Some of the catastrophes that you've had there. It's also just not really our kind of, area of expertise. We just looked at it differently. So yeah, look, I understand the argument for it. And at some point down the road, would we get into it potentially, but it's not on our current horizon.
Right. Absolutely. Does negotiating deals become easier when metal prices fall, or do cheaper metal prices bring in more competition for deals?
I think it's easier for sure. Oh yeah. Because look, I mean, there's less equity money available to go to those guys as well. Their share prices are depressed. So, non-dilutive financing, an alternative financing like a royalty makes more sense. So I'd say you definitely see a lot more deals. And they're usually better deals, to be honest, as well.
Right. What's your option when a company decides to reverse split its shares?
Reverse split our shares.
It might be, what is your opinion when a company decides to reverse split its shares?
Well, I don't usually, as a general rule, I don't really believe in any of that stuff unless it's as part of something, as part of some type of strategic goal. So it really depends on a case-by-case basis. If you were doing something because you needed to have a certain share price to get on an exchange somewhere or something like that, there are things that make sense. But I don't believe in doing any of that stuff on its own just for no reason.
Right, absolutely. Could you talk a little more about the use of proceeds from your recent financing and partial sale of your Seymour Lake royalty? Yeah,
so on a pro forma basis, we'd have about $8 million cash. And of that, we need $1.5 million to close out Zonia. So, from beyond that, we have a very thick pipeline of deals. We're trying to cherry pick. We've got about 40 deals in our pipeline, really trying to pick out those couple that we can do next. We have a Bissett Creek royalty option coming up. We're going to have to decide on that really in the next week or so here. That's about another $550,000 cash. So there's a couple things that we have, but we're really looking to save that capital. We might do stuff on a co-investment basis again, but really looking towards more cash flowing assets or near term. I think we want to add to our nickel exposure. We're a little bit light nickel right now. And there's some exciting, development projects that we like out there that are, within a couple of years of construction. But it's really about, we're going to take that time. We're not going to, deploy this capital too quickly. We think there's going to be good opportunities coming for the next, 3, 4, 6 months. So we're going to be patient and just make sure we do the right deals.
Right, absolutely. In your opinion, what differentiates Electric Royalties from other large royalty companies out there, like Franco-Nevada, Wheaton Precious Metals, and Sandstorm Gold, for instance?
Yeah, well, I think if you look at royalty company growth, a lot of the growth really happens at the beginning, and then it kind of peters out. So I think, in terms of opportunity, we're definitely more exciting from that point of view. What makes us different? I would say the upside, yeah, really from here, on a valuation point of view. All of our valuation is yet to be had over the next, I'd say, 3, 4, 5 years as our development portfolio really matures. So I'd say there's more upside and opportunity. Now, look, those guys are all precious metals focused, really. All of the big guys, Wheaton has done, one cobalt deal. But by and large, those guys are gold, silver, majority. And we are the only group out there, junior space included, that's really focused exclusively on these clean energy metals, which I really think is the higher growth opportunity as well. So, in terms of if you're looking for growth and some value accretion here over the next couple of years, that we're your pick.
Absolutely. Well, listen, I think that's all the questions of time we have for today. Brendan, I want to thank you as well as everyone that has submitted questions. If you didn't find a chance to ask a question, or even if you think of one just now, you can find their presentations on their website, www.electricroyalties.com, which includes contact information that can allow you to reach out directly to the team at Electric Royalties. Their tickers again being ELEC on the TSXV and ELECF on the OTC markets. With that, Brendan, I'd like to hand things over to you for a final word before we wrap up for the day.
Yeah, well, check us out. Our ticker is ELEC on the TSX Venture and ELECF on the OTC. So, check us out if you have questions. There's a lot of education that we feel like we have to do. But, it's hard to go wrong at our current valuation. Got a lot of catalysts coming this year. We're going to have a lot of cash to do deals in a market where there should be some good deals to be done. So, stay tuned. It's going to be exciting.